I am Dr. Naresh Shirodkar. I am Assistant Professor in Economics and I am from Nan Pasarag Middle College and Research Center, Asagaon, Goa. Today I am going to speak on the topic measurements of national income. As far as the outline of my topic is concerned, it is as follows. First, the output method. Second is the income method. Third is the expenditure method. And finally, I am going to speak on the topic nominal and real GDP. As far as learning outcomes are concerned, upon the completion of this e-module, students will be able to identify and classify national income measures. My first topic, what I am going to deal is measurements of national income. The first one is the value added method, or it is also called as product method or even output method. In this method, the contribution of each enterprise to generation of flow of goods and services is taken into consideration. Under this method, economy is divided into different industrial sectors such as agriculture, fishing, mining, construction, manufacturing, trade and commerce, transport, communication and various other services which are taking place in the economy. Then the net value added to the factor cost by each product to enterprise as well as by each industry is calculated or estimated. In other words, it is the sum of the gross value added. That is why it is called as product method or even output method. The second measurement of national income is income method. In this method, approaches national income from the distribution side. Under this method, national income is obtained by summing up in the sense addition of the incomes of all the individuals in a country. Since we are talking about macroeconomics, we consider all the individuals in the economy or economy as a whole. This includes rent. Now, rent is earned by the land, wages by the labor, interest is earned on the capital and profits are earned by the entrepreneur. Thus, GDP by income method is the sum of or the addition of all the factor incomes, that is the wages and the salaries, that is the compensation of the employees, plus the rent, plus the interest, plus the profit. All this will give you national income by the income method. Third and the last one is expenditure method. As the name suggests, expenditure method, this arrives national income through the expenditure incurred by the individuals. It arrives at a national income by adding up all expenditure made by the people on the goods and services during a year in an economy. Income of a person, or for that matter individual, can be spent either on the consumer goods in the sense fast moving consumer goods, or it can be on the capital goods which build the economy. Expenditure can be made by private individuals or by government. Private individuals can also undertake expenditure and government also undertakes expenditure. Government undertakes expenditure on various infrastructure projects which increase the welfare of the economy. So, the government expenditure is also very important as far as expenditure is concerned in the economy. So, both private expenditure and government expenditure play a very important role in the economy as far as generation of output and employment is concerned. All people of foreign countries spend on the goods and services which a country exports to them. Similarly, people of a country spend the income on imports of goods and services from other countries. By adding the expenditure by households, government and by the product to enterprises, we obtain national income. So, national income is nothing but C plus G plus I plus X minus M. So, C is the consumption expenditure which is incurred by the individuals, G is the government spending which is incurred by the government on various infrastructure projects, I is the expenditure or investment incurred by the private sector, X is the exports, M is the imports. So, X minus M, the difference between these two will give you net exports. So, consumption plus government expenditure plus investment plus net exports will give you national income through expenditure method. Finally, I am going to speak on the two concepts of national income, that is nominal GDP and real GDP. Nominal GDP measures national income at the current prices with no adjustment to the effects of inflation. For example, if my nominal income is £40,000 in 2012 and if my nominal income increases by 5% next year, then my nominal income will rise to £42,000. So, £40,000 of 5% is another £2,000, that will give me £42,000. pound. A real GDP measures the volume of the output. An increase in the real output means that aggregate demand has risen faster than the rate of inflation. Therefore, the economy is experiencing positive growth. Nominal GDP is measured in terms of money, whereas real GDP is measured against goods or services. A real value is one which has been adjusted for inflation. So, nominal GDP, in other words, is measured at the current prices. It tells you the value of goods at the current prices, whereas the real GDP speaks about the quantity of goods which are produced in the economy during a given year. So, for economy, what is more important is real GDP rather than nominal GDP. Nominal GDP will just show the rise in the price level, where the real GDP will show the positive growth which takes place in the economy. As far as my glossary is concerned, the following are my keywords: output method, income method, expenditure method, real GDP and nominal GDP. This is all about my presentation on macroeconomics chapter number 1, measurements of national income.